Hey everyone, welcome back to Corporate Decoder. Today, GMR Solutions Incorporated just filed their Q1 2026 report, and I am seeing a massive shift in their capital structure. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just went public in May 2026, and it looks like they are already making some pretty strategic moves with their money after that IPO. Alright, so GMR Solutions Incorporated is a big player in emergency medical services, and they filed this report for the quarter ending the 31st of March 2026. Now, after their big stock market debut in May, this filing gives us a look at how they are managing their finances right after becoming a public company. Let's dive into the numbers starting with their balance sheet. As of the 31st of March 2026, their total assets were a little over $7.3 billion. That is down slightly from the end of 2025. On the flip side, their total liabilities are also a bit lower, sitting at around $6.8 billion. What is interesting here is the mezzanine equity, which includes redeemable preferred stock. This has seen a pretty significant drop from over $445 million at the end of 2025 down to about $292 million by March 2026. This suggests they might have redeemed or bought back a good chunk of that preferred stock, which is often a sign they are cleaning up their capital structure. Now let's look at how they made money. For the first quarter of 2026, revenue was up by about 6.6% to $1.45 billion compared to the same period last year. That is a solid increase. But what is really driving the bottom line is their net income, which rocketed up by almost 180% to $106 million. This means they are not only bringing in more money, but they are also keeping a lot more of it as profit. Looking at earnings per S-Hair, basic earnings per S-Hair on a diluted basis was 28 cents in the first quarter of 2026. This is a big improvement from a loss of 3 cents per S-Hair in the first quarter of 2025. This jump in profitability clearly signals a much stronger financial footing. Remember that redeemable preferred stock I mentioned? Well, the notes to the financial statements give us more color. It seems they had some significant activity with their Series B preferred stock. On the 6th of March 2026, they redeemed about $189 million worth of this preferred stock. This kind of action usually happens when a company has enough cash or access to it, after things like an IPO, to start buying back more expensive forms of capital. Now let's talk about debt. As of the 31st of March 2026, their total long-term debt, including finance lease obligations, was just over $5.19 billion, which is pretty stable compared to the end of 2025. But what is really key is in the subsequent events section. They used a huge chunk of their IPO money to pay down about $670 million of their outstanding borrowings under their first lien term loan. This is a massive deleveraging move and significantly reduces their interest expenses. This is where things get really interesting. In May 2026, just after their IPO on the 14th, they completed a huge initial public offering selling over 31 million shares and raking in nearly $455 million in net proceeds. They then immediately used a big part of that money to redeem the remaining Series B preferred stock and pay down that massive chunk of their first lien term loan. They also sold about 33 million private placement warrants for $500 million, which is another significant cash inflow. They are also entering into a tax receivable agreement. This is a complex financial arrangement designed to let the company share a portion of the tax benefits it gets from pre-IPO tax assets with certain shareholders and management. They expect these payments to be material, which is something to keep an eye on as it can impact future cash flow. Looking at their business operations, the company highlights several long-term trends influencing their business. They point to the closure of rural hospitals, which increases demand for their emergency medical services. They also talk about the aging US population and the growing prevalence of chronic conditions, all of which are drivers for increased demand in healthcare, and specifically emergency care. They reported that same market revenue growth was 7.9% for the first quarter of 2026. This shows they are growing revenue in the markets they have been in for at least a year, which is a good sign for organic growth. Net cash capital expenditures were about $54 million for the first quarter of 2026. This is higher than the previous year and likely reflects investments in their fleet of aircraft and vehicles, as well as other operational assets. They track several key performance indicators. Patient encounters were over 1.3 million in the first quarter of 2026. Importantly, net transport revenue per ambulance transport increased to $1,360 from $1,260 in the same period last year. This indicates they are getting paid more for each transport. Let's look at the earnings before interest, taxes, depreciation, and amortization, or EBITDA. For the first quarter of 2026, EBITDA was $301 million, a significant increase from $256 million in the prior year period. This strong EBITDA performance underscores their operational efficiency and profitability. They also report adjusted EBITDA, which is a non-GAAP measure intended to show ongoing operational performance. Adjusted EBITDA for the first quarter of 2026 came in at about $305 million, an increase of over 9%. This metric also shows healthy growth. It is worth noting the cash used in aircraft financing arrangements was about $25 million for both periods this year and last. This highlights their ongoing investment in their aerial fleet, which is a critical part of their business. In terms of market risk, they are exposed to interest rate fluctuations. A 100 basis point change in interest rates would impact their earnings by about $36.4 million annually, which is substantial. They also monitor fuel costs, and a 10% change there would affect earnings by about $14.5 million annually. Finally, in a bit of news from May 28, 2026, they appointed Jessica Hall as their new Chief Accounting Officer. This is a key role, especially for a newly public company. So what is my take on all of this? GMR Solutions Incorporated is clearly in a transformative period. After their IPO, they are aggressively cleaning up their balance sheet, paying down debt, and consolidating their capital structure. The massive increase in net income and the reduction in preferred stock and debt are very positive signs. The fact that they are investing in capital expenditures like aircraft suggests they are confident in their future growth. My biggest concern is the complexity of the tax receivable agreement and how those future payments will impact cash flow over the long term. What I am actually looking for is how they will manage the ongoing interest rate and fuel price risks in this macroeconomic environment. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Alright, that is my take. Stay decoded. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.